Are there any common mistakes that real estate investors usually commit, which I should be aware of? Yes. If you want to earn a decent financial return when investing in the property market, you need to avoid the pitfalls faced by many investors and even some real estate professionals who really should know better. There are 10 common investor mistakes that you need to avoid. Okay, please share with us 5 of these mistakes today and we will tackle the remaining 5 tomorrow. 1. Waiting too long to invest. Fear is the key. Investors may be afraid of the unknown. They may fear failure, some even fear success. Strange as it may seem, some people actually feel undeserving of success and therefore fear becoming successful real estate investors. 2. Overanalyzing the property. There is nothing wrong with caution, but you should never become paralyzed by it. If you are considering 10 or 20 properties, checking and rechecking the figures, trying to cover all of the what-if scenarios, you could be overanalyzing the investment due to the fear mentioned above. The only way to be sure your analysis is correct is to put it to the test, having first discussed it with your real estate investment team, of course, by taking the plunge and buying your first investment property and applying proper due diligence after you have an accepted offer. Avoid analysis paralysis. Working with successful real estate professionals will give you the guidance you need. They already know the ropes and can offer you valuable experience. Determine the current value of your investment prospect with the aid of an appraiser, if necessary. Get to know the value of similar properties in the area and keep notes for use in future projects. 3. Jumping in too quickly. Many first-time investors are so anxious to start building their fortune that they often try to purchase the very first property they see. This can result in them signing a bad deal they should have avoided. One bad initial investment could turn you off real estate investing for good. That's why you need to do your homework first. First-timers may hear stories of instant riches and believe this is what will always happen. Although it can turn out that way, it is the exception, not the rule. Besides, you'll never know how much work went into being lucky. Remember, fools rush in where angels fear to tread. 4. Doing it on your own. Probably the worst thing a first-time real estate investor can do is try to do everything on their own. Surround yourself with successful, established investors and observe how they execute their deals. Most successful investors won't mind sharing their knowledge and strategies with those genuinely interested in learning how it's done. Build a team of professionals to help you execute your deals. Your team should include the following members: mortgage broker, investment realtor, insurance agent, accountant, contractor, property manager, lawyer. In addition, you will often need to turn to an experienced mentor, so look for someone you trust and respect. A well-chosen team is the key to success. 5. Giving up your day job. Some real estate investors fall in love with the dream of making investing a full-time career and resign from their day job after their first few deals have closed. This is usually a bad idea unless you have a lot of savings. A major consideration will be how your bank will react to such a move. If your bank is not convinced you can pay back your loans without receiving a regular monthly paycheck, they may be reluctant to lend to you. If they continue to lend, you may find yourself regarded as a no-income, no-assets customer. This may curtail your borrowing limit and result in a higher loan interest rate because of your perceived higher default risk. As a full-time investor, you need to spend a lot of time searching your local area for the right investment opportunity. Don't forget that even seasoned professionals sometimes get stuck in the doldrums with no deals closed for months. You should have at least 1 year of experience investing in real estate before even considering resigning from your day job. At that stage, you should be earning a healthy income from your investments. When you begin investing, you will need to be a jack of all trades, managing accounting, payroll, office supplies, paying creditors, etc. When your investments start to pay off, you may wish to expand in an office space or hire staff to maintain homes, etc. The best advice is to work part-time at real estate investment until you have learned the ropes and become established. Thank you. Let's meet again tomorrow to continue with the remaining common investor mistakes.